Hi all. Today we would be discussing exchange rate and the factors relativity. This is a new unit. So if we see what exchange rates are, it's like aside from factors such as interest rates and inflation, the currency exchange rate is one of the most important determinants of a country's relative level of economic health. Exchange rates play a vital role in a country's level of trade, which is critical to most every free market in the world. For this reason, exchange rates are among the most watched, analyzed, and governmentally manipulated economic measures. But exchange rates matter on a smaller scale as well. They impact the real return of an investor's portfolio. Here, we look at some of the major forces behind exchange rate movements. And before we look at these forces, we should sketch out how exchange rate movements affect a nation's trading relationships with other nations. A higher valued currency makes a country's import less expensive and its exports more expensive in foreign markets. A lower valued currency makes a country's imports more expensive and its exports less expensive in the foreign markets. A higher exchange rate can be expected to worsen a country's balance of trade, while a lower exchange rate can be expected to improve it. So if we think about dollar, which is a higher valued currency, so its imports, US imports are less expensive and its exports are more expensive in foreign markets. So anything in US dollars for us in India is more expensive than the rest. What are the factors which influence the exchange rates? Exchange rates are determined by factors such as interest rates, confidence, the current account on balance of payments, economic growth, and relative inflation rates. For example, if US business became relatively more competitive, there would be greater demand for American goods. This increase in demand for US goods would cause an appreciation in the that is the increase in the value of the dollar. However, if markets were worried about the future of the US economy, they would tend to sell dollars, leading to a fall in the value of dollar. So everything depends on the anticipation. So if you are anticipating and you are having a greater demand for American goods, what is going to happen? Because American goods are in demand, the US dollar value would increase. Whereas if there is if the market is not very sure of dollars or US economy as such, the dollar value will fall. Like we see here in this diagram, so there are D1 is the demand curve 1, and then there is an increased demand represented by D2, and the supply of goods is represented by S1. What is happening is that there is a rise, let us say, in the demand for pound sterling has led to an increase in the value of the pound to US dollar from 1.5 to 1.7. So when there is let us say more demand For pound sterling, its value has increased. Now, if inflation in United Kingdom is relatively lower than elsewhere, then UK exports will become more competitive and there will be an increase in demand for pound sterling to buy UK goods. Also, foreign goods will be less competitive and so UK citizens will buy fewer imports. Therefore, countries with lower inflation rates tend to see an appreciation in the value of their currency. For example, the long term appreciation in the German D Mark in the post war period was related to the relatively lower inflation rate. So, this is the first case of inflation. Then interest rates also affect the exchange rates. How do they do that? If United Kingdom interest rates rise relative to anywhere else, it will become more attractive to deposit money in United Kingdom. So you will get a better rate of return from saving in United Kingdom banks. Therefore, demand for sterling will rise. This is known as hot money flows, and it is an important short term factor in determining the value of a currency. So it is sort of the foreign portfolio investments will come into United Kingdom if the interest rate rises. So higher interest rates causes an appreciation of the currency, and vice versa would be true. That is, cutting interest rates tends to cause a depreciation of currency. So, if in India the interest rates are decreasing, that means the country is being depreciated. So, if we see in this diagram, then we can very well see that if there are increase in the United Kingdom interest rates, better return on United Kingdom saving accounts would be there. People would like to invest in there, and hence foreign portfolio investments would be attracted to in the United Kingdom. So hot money flows in to take advantage of higher rate of interests. Then because of that there would be increased demand of pound sterling, and hence there would be appreciation in the value of pound sterling. Hence, if a country, if the central bank in the country decides to increase the interest rates, what it is doing, it is creating a demand for that currency, the domestic currency in the world, and the value of the currency gets appreciated. Then the third uh, cause of change in exchange rates is speculation. So, if speculators believe that, let us say, we are taking example of United Kingdom in pound sterling, so sterling will rise in the future. They will demand more now to be able to make profit. So, this increase in demand will cause the value to rise. Therefore, movements in the exchange rate do not always reflect economic fundamentals but are often driven by the sentiments of the financial markets. For example, if markets see news which makes an interest rate increase more likely, the value of the pound will probably rise in the anticipation only. Hence, it would be the truth would be the vice versa, and that is the fall in the value of pound post Brexit was partly related to the concerns that the UK would no longer attract as many capital flows outside the single currency. Then another factor in change in foreign exchange rate is change in competitiveness. So if let us say British goods become more attractive, and competitive. This will also cause the value of the exchange rate to rise. For example, if the UK has long term improvements in the labour market relations and higher productivity, goods will become more internationally competitive and in the long run cause an appreciation in the pound. This is a similar factor to low inflation. So, what happens when your product is in greater demand? If, let us say, Indian products become, uh, let's say, there is cheap labor and there is higher productivity due to that, and the Indian products become popular in the world. So, people would like to buy that Indian products. While buying those Indian products, what are they doing? They are giving profit to the Indian companies. More and more foreign exchange reserve is coming to India, and the currency, the Indian currency, strengthens in comparison to other currencies and hence gets appreciated. So, this is how increased competitiveness of your products can appreciate your currency. Another factor that contributes to changes in the foreign exchange rate is the relative strength of other currencies. So in 2010 and 2011, the value of Japanese yen and Swiss franc rose because markets were worried about all the other major economies like US and European Union. So therefore, despite low interest rates and low growth in Japan, the yen kept appreciating. In the mid 1980s, the pound fell to a low against the dollar. This was mostly due to the strength of the dollar caused by rising interest rates in the US. So, if the other currency they get strengthened and you are stagnated, your growth, the domestic economy's growth is stagnated, then also your currency depreciates. So, if other currencies appreciate, your currency depreciates because you are not equating the growth the other countries are having. And vice versa is also true. The next important point is balance of payments. So, a deficit on the current account means that the value of imports of goods and services is greater than the value of exports of goods and services. Now, if this is financed by a surplus on the financial or capital account, then this is fine. But a country which struggles to attract enough capital inflows to finance a current account deficit will see a depreciation in the currency. For example, current account deficit in United States is 7% of GDP, and that was one of the reasons for the depreciation of dollar in 2006 and 7. Now, if we see in the diagram, the UK current account deficit reached 7% of GDP at the end of 2015, contributing to the decline in the value of the pounds. This was essentially due to the fact that imports were greater than the exports. So, when you are spending more through imports, if you are importing, then that means you are spending in the other countries, and if your spendings are more than your income, exports bring income, right? So when your imports are greater than the exports, then your balance of payment situation become negative and your currency depreciates. Then we come to government debt. So, under some circumstances, the value of government debt can influence the exchange rate. If markets fear a government may default on its debt, then investors will sell their bonds causing a fall in the value of the exchange rate. For example, Iceland debt problems in 2008 caused a rapid fall in the value of the Icelandic currency. For example, if market feared that United States would default on its debt, foreign investors would sell their holdings in US bonds. What will that create? That will create a fear in the market, and this would cause a fall in the value of US dollar. Then, government intervention also is responsible for changes in the foreign exchange reserves, foreign exchange rates. So, some governments attempt to influence the value of their currency. For example, China has sought to keep its currency undervalued to make Chinese exports more competitive. They can do this by buying US dollar assets, which increases the value of the US dollar to Chinese yuan. Then, economic growth and recession in the domestic country also predicts the foreign exchange rate. So, a recession may cause a depreciation in the exchange rate. And why would that be so? Because what happens in recession? Interest rates falls. Also, in recession, the production takes a hit. So, your exports would also be, it's a possibility that your exports become lesser, your interest rate falls, and what happens with these two things? Yes, the currency depreciates. But actually, there is no hard and fast rule for that. So it depends on several factors. Like during the period of 2007 to 9, the value of sterling fell over 20%. And this was due to various reasons. Like first, restoring United Kingdom's lost competitiveness. So the United Kingdom had large current account deficit in 2007. Then Bank of England cut interest rates to 0.5% in 2008. So that was the decrease in interest rate, and the previous one was the because of the lack of competitiveness, your the imports increased and exports declined. Then the recession hit United Kingdom economy very hard. Markets expected interest rates in the UK to stay low for a considerable time. Hence, there was fear, and hence it depreciated the UK currency, that is sterling pound. Now, the Bank of England also pursued quantitative easing, that is, they increased the money supply in the economy. This actually increased the inflation, hence making the UK bonds less attractive, and the currency, it left the currency depreciated. So there can be a number of factors because of which economic growth or recession can happen, and in that time the currency depreciates. Let us now understand how government intervenes in the foreign exchange market and what it exactly is. So, a foreign exchange intervention is a monetary policy tool that involves a central bank taking an active participatory role in influencing the monetary funds transfer rate of the national currency, usually with its own reserves or its own authority to generate the currency. So, central banks, especially those in developing countries, intervene in the foreign exchange market in order to build reserves for themselves or provide them to the country's banks. So, their aim is often to stabilize the exchange rate. So, these are basically the efforts. Foreign exchange interventions are actually the efforts by central banks to stabilize a currency. Destabilizing effects can come from both market or non market forces. Currency stabilization may require short term or long term interventions, and stabilization allows investors to be more comfortable with transactions using the currency in the question. Now, if we want to understand foreign exchange intervention, let us understand one thing, that when a central bank increases the money supply through its various means of doing so, it must be very careful to minimize unintended effects such as runaway inflation. So, the success of foreign exchange intervention depends totally on how the central bank sterilizes the impact of its interventions, as well as general microeconomic policies set by the government. Two difficulties that central banks face in doing so are determining the timing and amount of intervention, because it is often a judgment call rather than a cold hard fact. So, the amount of reserves, the type of economic trouble facing the country, and the ever changing market conditions require that a fair amount of research and understanding be in place before determining how to take a productive course of action. Now, in some cases, a corrective intervention may have to be taken shortly after the first attempt. The one question that can come to your mind is why governments intervene. So, foreign exchange intervention comes in two flavors. Firstly, a central bank or government may assess that its currency has slowly become out of sync with the country's economy and is having adverse effects on it. So, for example, countries that are heavily reliant on exports may find that their currency is too strong for other countries to afford the goods they produce. So, they may intervene to keep the currency in line with the currencies of the countries which import their goods. The Swiss national banks took this kind of action from September 2011 to 2015. So, Swiss National Bank set a minimum exchange rate between the Swiss franc and the euros. This kept the Swiss franc from strengthening beyond an acceptable level for other European importers of Swiss goods. Now, this approach was successful for 3.5 years, after which the SNB, the Swiss National Bank, determined that it had to let the Swiss franc float freely, suddenly without prior warning. So, the Switzerland Central Bank released the minimum exchange rate. This had highly negative consequences to some businesses, but generally, the Swiss economy has been unfazed by the intervention. Also, the interventions can also be short term reaction to a certain event. A one off event may cause a country's currency to move in one direction in a very short space of time. Central banks will intervene with the sole purpose of providing liquidity and reducing volatility. After the Swiss National Bank lifted the floor in its currency against the euro, the Swiss franc plummeted by as much as 25%. So, Swiss National Bank intervened in the short term to stop the franc from falling further and curb the volatility. So, we can see that under certain circumstances, the government might want to intervene in the foreign exchange markets to influence the level of the exchange rates. What are the methods to influence the exchange rates? The first is reserves and borrowings. If the value of an exchange rate is falling and the government wants to maintain its original value, it can use its foreign exchange reserves, like for example, selling its dollar reserves and purchase pounds. So, this purchase of pound sterling should increase its value. The second method is by borrowing. So the government can also borrow foreign currency from abroad to be able to buy sterling. The third is changing interest rates. So in United Kingdom, this is now done by MPC, that is the higher interest rates will cause hot money flows and increase demand for sterling. Higher interest rates makes it relatively more attractive to save in United Kingdom. So if investors wish to save in United Kingdom, then there will be more demand for pound sterling and the exchange rate will appreciate. However, the higher interest rates do have the effect of depressing demand in the economy. So the government may be reluctant to depress demand just to increase the value of the currency. Then another way is to reduce inflation. Through either tight fiscal or monetary policy, the government can reduce aggregate demand and hence inflation can be reduced. By decreasing aggregate demand, consumers will spend less and purchase fewer imports, and so will supply fewer pounds. So, this will increase the value of the ER or the exchange rate. Now, the lower inflation rate will also help because British goods will become more competitive. Thus, over time, the demand for sterling will rise. However, this policy has an obvious side effect because lower aggregate demand will cause lower growth and higher unemployment. Then there is another measure, that is the supply side measure, to increase the competitiveness of the economy. So this will take a long time to have an effect, but it's successful. The UK exports will become more competitive, increasing demand for the sterling. The next method is to join fixed exchange rates. So one method to influence the exchange rate is join a fixed or semi-fixed exchange rate. The idea is that if the government are committed to a particular target, it may encourage speculators to expect currency to stay within the range. However, in practice, investors may feel government exchange rate targets are never guaranteed and are actually an opportunity to speculate against the government. So, in response, the government raised interest rates to 15% and bought pound sterling on the foreign currency reserves. However, this was insufficient to stop the pound falling. Eventually, the government had to give in to the market pressures and exit the exchange rate market. Now, the government intervention failed because the market felt the government's intervention was not sustainable. So interest rates of 15% were disastrous for an economy already in recession. Therefore, high interest rates were insufficient as the markets correctly bet interest rates would have to fall and the government devalue. Now, after fighting the inevitable, the government eventually was forced to leave the exchange rate market in October 1992, and this enabled a fall in interest rates and an economic recovery. So this has been an example in United Kingdom. So there is an example of Chinese intervention in Chinese currency as well. So in the past few decades, the Chinese have often followed a policy of keeping the Chinese currency, that is renminbi, undervalued. China runs a current account surplus due to strong export sector. So with these foreign currency reserves, they have bought foreign assets like US Treasury bonds. So this leads to increase in the foreign currency reserves, but more importantly, by buying US assets and supplying Chinese renminbi, the Chinese government is effectively reducing the value of renminbi. So the motivations for selling Chinese currency to buy US assets is that by keeping the currency undervalued, Chinese exports remain very competitive. So this increases economic growth and provides jobs for many workers leaving low paid agricultural work. At various times, US commentators have criticized this policy for being a case of currency manipulation. So the argument is that by keeping the Chinese currency undervalued, the dollar is overvalued, causing a loss of US jobs. And hence, if we see because of this undervaluation of currency, the Chinese goods are much cheaper and the foreign direct investment flows are also increasing in China because of this undervaluation only. So all this discussion we did today was about the foreign exchange rates, what are the factors that changes them, and why and how government intervenes in the markets. These are the reference. Thank you for listening.